What if I told you that investing in stocks and bonds is one of the easiest and most effective ways to build wealth over time? Even if you're starting small, whether you're saving for a dream house, your kids' college, or retirement, smart investing puts your money to work for you. But here's the catch. It's not about chasing trends or timing the market. It's about consistency, time, and the right strategy. I'm talking about slowly building wealth, not getting rich quick. If you're looking for get-rich-quick schemes, you've landed on the wrong channel. The Lazy Investor is all about replacing money myths with tried and tested truths. It's for entrepreneurs, investors, beginners, and veteran investors alike. Anyone who wants to build wealth over time, 5, 10, 20 years. Anyone who wants to learn all about investing in technology, stocks, bonds, crypto, real estate, and investing in their futures. If you want to be financially free or retire early, this is the channel for you, so lock it in. Click the subscribe button, give it a like, and click the ring-a-ding-ding. Today, it's all about stocks and bonds, fully explained. In this video, I'm breaking it all down, how to invest in stocks and bonds, with a focus on a long-term mindset, so you can hit those big life goals, build real wealth, and be able to sleep peacefully at night. Here we go, let's get into it.
Your money's working while you do less. Stay lazy, let your money do the rest. The Lazy Investor.
First up, stocks, specifically index funds like the S&P 500. The S&P 500 is a collection of the 500 largest companies in the U.S. When you invest in it, you're not betting on one company. You're investing in a slice of America's biggest businesses, all at once. We're talking about giants like Apple, Microsoft, Amazon, and hundreds more. Over the last several decades, the S&P 500 has averaged around 8% to 10% annual returns after inflation. That's why long-term investors love it. It grows steadily over time despite the occasional market crash or downturn. If your goal is retirement, buying a house, or just building generational wealth, investing in the S&P 500 is one of the simplest, most effective moves you can make. Now, you no longer have to pick individual stocks or constantly watch the market. Instead, you can invest in ETFs, exchange-traded funds. An ETF is like a basket of stocks that you can buy and sell just like any other stock. There are ETFs that track the S&P 500, like FU from Vanguard or SPY from State Street. And you can also find ETFs for tech stocks, international markets, and even dividend-focused companies. With ETFs, you get instant diversification, lower risk, and often lower fees compared to actively managed funds. It's a set-it-and-forget-it option that works great for long-term investors. And here's where it gets even easier. Auto investing. Most modern investing apps let you automate your contributions. You pick an amount, pick the schedule, and it invests automatically. This is called dollar cost averaging. Instead of trying to time the market, you're investing the same amount regularly, whether the market is up or down. Over time, this smooths out your costs and builds your wealth with less stress. Apps like Fidelity, Vanguard, Schwab, and even M1 Finance let you automate your investments in stocks, ETFs, and bonds. If you want a more hands-off experience, platforms like Betterment or Wealthfront can build and manage a diversified portfolio for you, all on autopilot. Now, let's talk bonds. Bonds are often overlooked by beginners, but they play an important role, especially as you get closer to your financial goals. So what is a bond? When you buy a bond, you're basically lending money to a government, municipality, or corporation. In return, they pay you interest, usually twice a year, and return your original investment when the bond matures. There are different types of bonds to know. Treasury bonds issued by the U.S. government. They're ultra safe, but offer lower returns. Municipal bonds issued by states or cities. These can be tax-free, especially for local investors. Corporate bonds issued by companies. They typically pay higher interest but carry more risk than government bonds. There are also bond ETFs like BND from Vanguard, which give you exposure to a broad range of bonds without having to buy individual ones. This makes it easier to diversify and reduce risk. A smart long-term portfolio often includes both stocks for growth and bonds for stability. Stocks help your portfolio grow over time, while bonds help protect your money when the market gets volatile. Here's a sample. Long-term strategy if you're starting out. 70% in stock ETFs like FU or SPY for growth, 20% in bond ETFs like BND, for stability 10% in cash or other assets like REITs or precious metals for diversification. If you're younger and have decades before retirement, you might go even heavier on stocks. As you get older, you can gradually increase your bond allocation to reduce risk. The key is balance and making sure your investments match your personal goals and timeline. Now, let's talk about the apps that make this simple. Vanguard, great for low-cost ETFs and index funds, plus access to the S&P 500 and bond funds. Fidelity, no minimums to start with fractional shares and automated investing options. Schwab, known for low fees and user-friendly tools for both stocks and bonds. M1 Finance, perfect for automating your own custom portfolio. You pick the slices of stocks, bonds, ETFs, and the app auto-invests for you. Betterment and Wealthfront. Ideal if you want a robo-advisor to manage everything for you, including automatic rebalancing between stocks and bonds. And remember, time is your greatest asset. The earlier you start, the more time compound growth has to work in your favor. It's not about timing the market. It's about time in the market. So whether you're starting with $100 or $1,000, just start. Set your plan, automate it, and stay consistent. That's how you go from hoping for wealth to building it. Stay lazy. Let your money do all the work. And I'll see you in the next one. Watch this video next.